Welcome to Factful Finance. Let's kick things off with a question. What if I told you that having a diversified investment portfolio is one of the best ways to safeguard your wealth in both booming and turbulent markets? That's right. But how do you go about building one? Don't worry, we're breaking it all down today. Before we dive in, just a quick disclaimer. The content shared here is for educational purposes only. We recommend consulting with a professional financial advisor for personalized advice tailored to your needs. So let's get started. Building a diversified investment portfolio is a powerful strategy to spread risk and potentially maximize returns. But what does that really mean in practice? Let's break it down. First, let's clarify what diversification is. In simple terms, diversification is about not putting all your eggs in one basket. If you were to only invest in one company, for example, your entire portfolio would be vulnerable to that company's performance. But by investing in a mix of assets, stocks, bonds, real estate, and even international investments, you reduce the risk of any single investment causing significant harm to your overall portfolio. Now let's get to the nuts and bolts of building a diversified portfolio. Step 1. Asset allocation. This is the process of deciding how to divide your investments among different asset classes: stocks, bonds, real estate, and others. For example, if you're in your 30s and have a long investment horizon, you might lean more heavily on stocks, which tend to offer higher returns over time. But if you're nearing retirement, you might want to shift toward more stable assets like bonds or dividend-paying stocks to minimize risk. Step 2. Sector diversification. Even within your stock holdings, it's crucial to diversify across sectors. Technology, healthcare, energy, and consumer goods are just a few examples of sectors that behave differently depending on market conditions. Imagine if you invested heavily in tech stocks during the 2000 dot-com bubble, many would have lost a lot of value. But by balancing your exposure to different sectors, you shield your portfolio from sector-specific downturns. Step 3. Geographic diversification. Don't forget about global diversification. The US market has historically performed well, but what about emerging markets or international stocks? Having investments in different regions allows you to take advantage of growth in other parts of the world. For example, China and India are home to rapidly growing economies, and by including some international investments, you can potentially tap into these opportunities. Step 4. Risk tolerance and rebalancing. Diversification doesn't mean just setting up your portfolio and forgetting about it. Over time, some investments will grow faster than others, shifting the balance. Rebalancing ensures that your portfolio stays aligned with your original asset allocation. Plus, regularly reviewing your portfolio allows you to adjust for changes in your risk tolerance. If you're nearing retirement, for instance, you may want to reduce the portion of stocks in your portfolio to lower the risk. Let's take a look at a real-world example. Meet Noah, a 40-year-old tech entrepreneur who has $100,000 to invest. Instead of putting everything into high-risk stocks, Noah decides to allocate his funds as follows: 60% in stocks, with a mix of US and international companies, 20% in bonds, and 20% in real estate through a REIT, Real Estate Investment Trust. By doing this, Noah is spreading his risk across different asset classes, sectors, and regions, reducing the chance that a downturn in any one area will hurt his portfolio. Another case is Emma, a 55-year-old marketing professional nearing retirement. She has a $200,000 portfolio and wants to reduce risk as she approaches her retirement years. Emma reallocates her funds, increasing her bond holdings to 50% while reducing her stock exposure to 30%. She also keeps 10% in real estate investments and 10% in cash for liquidity. By diversifying across different asset types and adjusting for her risk tolerance, Emma is better prepared for the future. The beauty of diversification is that it can help weather market volatility. Historically, diversified portfolios have performed better over the long run compared to those concentrated in just one asset class. In fact, a recent study by Vanguard found that portfolios with at least 60% equities and 40% bonds performed better on average than those that were more heavily weighted in one asset class over the past 30 years. Remember, though, that diversification isn't about avoiding risk entirely. It's about managing and spreading that risk to reduce the chances of any single event wiping out your investments. What's your biggest challenge when it comes to building a diversified investment portfolio? Share it with us in the comments below. Thanks so much for watching Factful Finance. If you enjoyed this video and want more insights on making smarter financial decisions, why not hit that subscribe button? We think you'll enjoy the next video on screen, and who knows, it might just be the key to taking your financial journey to the next level. Take care, and remember, diversify to secure your future.